Welcome to the Nichols Tax Update Podcast, issue 21-22 for June 1st, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I wish to acknowledge the value in preparation of this program of my subscription to Tax Notes Today. Published by tax analysts, it is the primary source of information, together with www.irs.gov, to which I refer in the preparation of this program, which is designed for tax professionals. So, here we go. Five events this week. The IRS disagrees with the Sixth Circuit again on the classification of split dollar life insurance benefits, but that's not really a new issue. It's been an issue for a long time. Next, worthless stock of a subsidiary. Is it ordinary or capital loss? This is a fairly complex topic. Sometimes we're criticized for taking topics that are too complicated, sometimes for topics that are too simple. We try to strike a happy medium. Sometimes it's basic stuff. Sometimes it's really complex stuff. So we'll see about how do you determine whether the worthless stock of a subsidiary is an ordinary loss or a capital loss. Then when do you have income? It's an old question with new twists. Can I have taxable income before any transfer of property, rights to use property, or performance of service? That's another question, separate from when do I have income. Next, the California District Court, of all places, sorts out the question of willfulness against a complex history of finances affected by federal bureaucracy and a pandemic. It's a fascinating story of trying to serve two masters when both masters are federal agencies with different agendas. Here, in this action on decision, the IRS announces that it will follow a tax court decision, not the Sixth Circuit. In Machichek, the IRS will not follow the Sixth Circuit's decision that with 301 regulations on the treatment of split dollar life insurance benefits. The IRS says if split dollar life insurance benefits are provided to a shareholder employee, they are provided as wages if they're provided as part of an employee plan. If there is no shareholder plan, the benefits could hardly be provided as a shareholder benefit, which would be a non-taxable distribution as opposed to taxable wages, subject not only to income taxes, but also subject to payroll taxes. These facts are virtually identical to a case we reported on in the April 19th edition. Dr. DeSantos. Let's take a look. Ruben de los Santos, TC number 9 on April the 12th, 2021. The tax court sticks to the plain wording of the statute to disagree with the Sixth Circuit on the nature of currently taxable benefits of a split dollar life insurance policy, the benefits to a shareholder employee. And we show the court's emphasis by using all caps above because that's the determining factor. Dr. DeSantos S Corporation adopted an insurance plan providing benefits to all employees. No benefits were offered to shareholders, so the split dollar benefit must be included in Dr. DeSantos' wages as ordinary income and subject to payroll taxes, with all the penalties for late filing of the return and late filing of the taxes that go along with that. The bottom line, providing a split dollar life insurance benefit to a shareholder employee pursuant to an employee benefit program is going to be includable in the shareholder employee's wages. Why is that hard? Then gross receipts test is necessary to prove an ordinary loss. Sometimes stuff gets in here because I look at it and I think, what? Whoever does this? But I'll tell you who does this. Is the chief accounting officer for a corporation that has acquired a number of other corporations over time. There have been mergers and acquisitions, and one of those subsidiaries goes bust. Do we have an ordinary loss, immediately deductible, or do we have a capital loss that might not be deductible because we have no capital gain? This is an article in Tax Notes Today, article by Emily Foster. She picked up a conversation from a tax conference where an IRS frightwig, a big shot, talked about this issue. You cannot avoid the gross receipts test for determining whether ordinary loss treatment applies. Determining worthless stock of a subsidiary involves what constitutes a security, the timing of the worthlessness, the amount of any loss, and most significantly, the character of the loss. Is it ordinary or capital? But that's a question that's decided under Code Section 165G3. Let me be honest. I did not know what Code Section 165G3 was. I had to look it up. 90% of a subsidiary's gross receipts must be attributable to active sources from the beginning of time till the present, the corporation's entire history, if you want to have ordinary loss treatment. It's easy if you've always owned that subsidiary. If you organized it and you've always owned it, you know what its history is. But what if you acquired that subsidiary in a corporate reorganization? And what if that subsidiary had been previously acquired by another corporation? You have to know that subsidiary's history from the beginning of time, for all time, to make a representation that 90% of its gross receipts have always been from the active conduct of a trade or business. Now, and all this stuff is determining who is a dependent, right? Some of this stuff is hard. The income was not enough to require reporting. Are you kidding me? How do you get to that? Well, John Legosky got there. He bought and sold items online using a drop ship model and had unreported income from sales. But Amazon knew how much revenue he had because they had processed his payments. They sent him a 1099-K for $29,501. But according to Mr. Legosky's tax lexicon, that was below the reporting threshold for these third-party network transactions, so he didn't have to report the income. Wait a minute. It's below the reporting threshold, so you don't have to report the income. It does not matter. It could be $1,000, and you have to report the income. That's what the law says. This fellow is not entitled to offset his gross receipts with any cost of goods sold because he failed to report any substantiation. The judge said, you know, under this thing called the Cohen Rule, if you had shown me you had some expenses, I might have let you estimate your expenses. But you were so certain that your income was below the threshold that you never bothered to submit any information about your expenses. And so you lose, Mr. Legosky. You have $29,501 of unreported income. I love it. Now we have a question of a taxable event. When does it occur? And this is astounding because the IRS is outside the box. Joshua Jarrett, he's down in Tennessee. He's part of a network that creates a new type of Bitcoin, a new type of token. So his Tezos token, this electronic money, he created 8,876 new tokens during the year that have fair market value of $9,407 when they were created. We don't know how much they were worth at year end. We just know they were worth $9,407, which was what people who would take them took them at a value. So we now have a proliferation of these types of currencies that use blockchain, where they're trying to establish what is essentially a sanitized form of trading. They're just the old, I'll trade you 2 cats for 1 dog. That type of transaction has been of interest to the IRS for a long time, but now it can be organized through a Bitcoin type currency. If I am willing to accept your Tezos tokens because I know where I can spend them, we have created a form of transaction, a form of monetizing a transaction. Now, the Jarretts did not sell or otherwise transfer any of those tokens during 2019, but they were mistaken and they reported their value as other income. They now seek to remedy that mistake by filing a claim for refund. And by the way, this proliferation of Bitcoin type currencies is represented by this proliferation of what some of those coins look like. Now, those are the representations of this proliferation of currency type tokens. Anyway, they filed a claim for refund. The IRS didn't respond. When the IRS doesn't respond, you got no choice but to file a suit to recover the overpayment, which is what they did. The court said the value of property simply created by the taxpayer should not be reported as taxable income. But wait a minute. They didn't really get me to the threshold of what is a taxable event. So, income is required to be recognized when there has been a taxable event. There we see here we have an exchange in the little picture on the screen. A taxable event occurs when there is an increase in wealth of a taxpayer. The examples are when I receive a paycheck, if I sell shares of stock, if I receive interest from my savings account, it's credited to my account, it's mine, I can take it any time. If I sell property of any kind, I give up the property, I get the money or I get the tokens. All of those descriptions describe a closed or completed transaction that determines both an amount and the unrestricted right to receive that amount. Without a taxable event, income cannot be measured. You might reasonably, therefore, apply the all events test, which we use to determine liabilities and deductions on one side, to the income side of any transaction. At least I think you can. And if you think about it, that works. It works on both sides of the transaction. Have all events necessary to establish my right to it and the value, or my obligation to give it up and the value. Either way, it's a taxable event. Finally, a taxpayer did not willfully fail to remit taxes withheld from employees' wages to the IRS. It was not his stubborn refusal. It was a confluence of conflicting federal regulations and economic circumstances. And he got this opinion from a district court in California. Saints be praised. Operator of a nursing home did not demonstrate willfulness. He acted reasonably in trying to comply with federal and state regulations requiring timely remittance of withheld payroll taxes in operation of his business. Allegations against James Primesberger did not demonstrate willfulness as a matter of law under Code Section 6672, which is the operative section here. Here's what happened. First, his nursing homes had cash flow problems because of delays and disruptions in Medicare and Medi-Cal payments in California. That was the predominant source of their revenue. He had 5 nursing homes, and over 80% of the occupants of his nursing homes were Medicare patients. So Mr. Primesberger is depending on the state government and the federal government to pay the amounts that he's billed them, for which he's billed them, that he says is due. But they had sent some inspectors, and while the inspectors were there, the paying agencies slowed down their payments. So Mr. Primesberger can't get the money he needs to run his nursing homes. Cash flow issue got so severe, they could no longer pay the operational expenses. But wait a minute, the facilities are required to stay open. They have those people that require skilled nursing care, that they are required by law to stay open and maintain the existing standard of care for all of their residents. Their failure to maintain that standard could result in both civil and criminal penalties for Mr. Premsberger. He's caught literally between a rock and a hard place, between two governmental agencies. One won't pay him, and the other one will not allow him to stop paying his bills. We need to know a little bit more about this. He negotiated a sale. He got so frustrated, he said, look, I give up. I'm going to sell these nursing homes. And he found a purchaser who agreed to close no later than November 1st, 2014, and agreed to pay the withholding tax liabilities, which existed at that time for 2 quarters. Premsberger believed the sale would maintain the standard of care, which he was required to do, and provide sufficient funds to satisfy any outstanding withholding taxes. He had a contract with what he believed to be a financially responsible buyer. Meanwhile, relying on that contract, he negotiated a loan to meet the cash flow needs and maintain the standard of care, not to pay the taxes, because the buyer had agreed to do that. So the loan, all the loan would do, would pay the net payroll. But the sale didn't close until March 1st of 2015. And the buyer did not keep the commitment to satisfy the withholding tax liabilities. Premsberger is in the soup. The IRS alleges he's liable for penalties for the unpaid withholding tax liabilities for 5 quarters, for 5 different nursing homes. That kind of payroll, that kind of money is more than Premsberger could ever hope to put together. So the IRS alleges he's liable. Not so, says the district court judge. He attempted to meet these 2 ongoing duties, both required by federal law. Pay the trust fund taxes, a duty that applies to all businesses and would have been done with the contract that he negotiated, and maintain the standard of care, which he did by borrowing the money to maintain the standard of care in reliance on the contract. He did the best he could under the circumstances, and that's not willful, and therefore he is not personally responsible for the unpaid taxes. Every now and then, you get a federal district court that understands business and makes good decisions. Well, gang, that's it for another week. What a wide variety we had this week. Thank you for your attention and your support. Meanwhile, stay safe. Fewer and fewer mask requirements. More and more of us are vaccinated. This will all be in the rearview mirror soon.